If you have low rates of interest, in theory, that should lead to credit expansion and growth in the real economy. But what if the reason banks are not lending is really not because of interest? How low do you have to bring down interest rates for banks to lend to a manufacturer that does not have power? Or for a bank to lend to a company that's operating in an environment where there is no security or where there is no infrastructure? At what rate of interest would a bank lend to a tomato farmer who is going to lose 50% of his output between the farm and the market because there's no investment in storage and cold rooms? These problems are structural. They're not problems that are fixed by moving interest rates up and down. You have issues around land use. You have issues around customer identification and credit records. You have issues around infrastructure and power. Most of the SMEs that don't have access to credit don't have access to credit because the environment is not one in which the businesses themselves thrive. So we have serious questions. And when we had MPR at 8%, how much were the banks lending to these small and medium enterprises? It still wasn't much.